Joining us now to dig deeper into the banking crisis and how we can protect our money is John Sedunov, Associate Professor of Finance at Villanova University. Hi, John.
Hi there. Thanks for having me.
So, John, tell us, Silicon Valley Bank was on the Federal Reserve's radar for more than a year, was repeatedly warned it wouldn't have enough cash on hand in the event of trouble. So why wasn't the collapse prevented?
I think that's a great question, and I think it's one that more of this is going to come to light over time as we uncover more from regulators, from people who are on the ground. You know, when you think about the bank's position with the very high level things that regulators and markets might look at, they weren't subject to as stringent of a stress testing regime as maybe some larger institutions. So, you know, potentially from the big picture 50,000-foot view, regulators may not have viewed them as a larger concern. It's not totally clear at this point, as we're talking now, why, though these things were apparent when you look at their quarterly filings, you can see their interest rate mismatch, you can see their liquidity issues. It's not clear why regulators didn't do something to stop it then. And I think we're going to discover more in the coming weeks and months ahead.
Absolutely. And why do these bank collapses keep happening? You know, can't we learn from our past mistakes?
I think we do learn from the past mistakes, but when we think about regulation that follows a financial crisis, we typically are fighting the last fire instead of looking forward to fighting the fire that's coming next. And so the regulations that happened in the past 10 or 15 years as a result of the global financial crisis in 2008, they're related to mortgage lending, they're related to capital adequacy, to some degree liquidity. And all of these things, again, Silicon Valley Bank relatively would have been fine with. So again, when you think about what's the next crisis to come, the regulations that are on the books don't always cover that. It's not always clear where the next crisis is going to come from.
Right, and hearing a bank collapse makes everyone nervous, but we don't have to be, depending on the amount of money in your account, right? I mean, how can we protect our money?
Right. So the first thing you should do before anything is talk to your financial advisor and make sure that you've got a plan with them. But as individuals, when you think about insurance and the FDIC, if you have cash at the bank, the FDIC will insure you up to $250,000. But if you've got more than that and you want to think about how to protect that, you could consider having separate accounts at different banks. You can have $250,000 per bank. You can have $250,000 per person in your household. So even if you want to stay at your same bank, potentially you create a second account with other members of your household or family. So it's not that you're totally out there and without help and without protection. The FDIC insurance will cover you. And again, if you got more than that minimum, you have the ways we just talked about here to kind of spread out and enhance your protection.
All right, good to know. John Sedunov, Associate Professor of Finance at Villanova University. Thanks for being here.
All right, thank you again for having me.
Hi, I'm Christine Persichetti, anchor of Currents News. If you like what you saw, please hit the like button on this video. And if you want to see more content just like it, subscribe and click on the bell for notifications. Thanks for watching, because we are putting your faith in the news.